If there's one thing we can all agree on, it's that our housing market is in a bit of a funk. What's harder to find consensus on at the moment is where prices should head from here. Housing Minister Chris Bishop wants them to go down. Prime Minister Christopher Luxon wants them to go up. Modest increases, he says, which is the same line Jacinda Ardern used. Cameron Bagrie is with us this morning, lead economist at Bagrie Economics. Hey Cam Bag, how are you?
Yourself?
Good, thank you. The age-old question, but at a time like this where, the economy sort of having a recovery stall during quarter two, tell us about the wealth effect of property. It's an important concept. What is it?
Well, I guess if you look at consumer spending, there's two main drivers. One driver is obviously wages, the money that you're getting coming in the door. Food inflation can eat into that pretty quickly, but the wealth effect is an effect that describes the impact of rising asset prices, whether that be the equity market, whether it be the farm, whether that be the house. And the bottom line is that when you feel wealthier, or you think you've got a build-up in what's called paper money, you're inclined to spend a little bit of that paper money, particularly on things such as durables, i.e. you might get out there and buy another car, you might go on a fancy holiday, you might rip the kitchen out and replace it with a new kitchen, get a spa pool. But statistically or traditionally, that wealth effect has been a very strong driver of New Zealand consumer spending trends.
So it's a real thing. It's a bit of an ego boost, if you want, something that can get you out there and actually swiping your card, a bit of a confidence boost. It's not something you want to rely on long term, but can you see why some politicians in the short term like it?
Yeah, it's what's called sugar candy economics. If you want to get the economy going, you get the housing market going. If you look at, unfortunately, some sectors of the economy really suffer during a downturn. This is consumer spending, the housing market. When interest rates go up, asset prices go down, and consumer spending, we take a hit. We tend to tighten the belt. Well, the reverse operates as well. When the economy starts to go pretty well, and this is partly because there's a certain synchronisation between the property market and the general economy. If the property market starts to pick up, then you're going to see that happiness factor across the economy. A little bit of paper wealth, a little bit of artificial wealth drives a little bit more of that feel-good sort of factor. People get out there and spend a little bit more. But your bottom line, Ryan, you don't get truly wealthier selling more expensive houses to each other. And New Zealand's had an economic model for 30 odd years where house prices have grown at 7% per year on average, and income growth has grown at 4 to 5. It's unsustainable. So yes, we want to see house prices pick up, but at a moderate pace as opposed to a pace in excess of income.
Galloping off like they did post-COVID. How do you sort of wean yourself off that model? What does that transition look like, or is it happening?
Well, I think it's actually starting to happen, and it's a good thing. Why? Because house prices are still in the unaffordable zone. If you look at house prices to income, depending on which measure you look at, you can get house prices up around sort of 6, 7, 8% of income, which is still pretty high compared to what we're seeing internationally around the globe. If you're an investor at the moment looking at residential property, it's pretty hard to make the numbers stack up. Yes, interest rates are coming down, so that's making your borrowing costs a little bit lower, but your rates are going up at a double-digit rate. Your insurance costs are going up at a double-digit rate. So the mass on residential property investment at the moment is hardly what you call enticing in regard to bringing people into the market, which is ironically one of the reasons we're seeing the market being weak at the moment, because there's not an awful lot of price tension between investors and first-home buyers. So it's still a little bit of a first-home buyer market, so to speak. The market will pick up, but it's taking time. People just need to remember that households so far have only seen the benefit of 70 basis points of interest rate cuts. Why? Because everyone's got a 1 and a 2 year fixed mortgage rate. The Reserve Bank's gone 250 basis points, but that effect does not immediately transfuse into borrowing costs. It's coming with a bit of a lag. So the pickup in the property market will be a 2026 story. It's coming, but we hope it's going to be a modest pickup. Not one of those rip-roaring ones that we've seen traditionally.
Hey, just very quickly, your thoughts on the RBNZ's proposal for capital requirements for banks, for big retail banks in New Zealand. From what I spoke to Sam Stubbs this morning about this, not going to have a major effect in terms of the security of the banking system, but also not going to have a major effect on what the lending costs might be for us, how much capital's out there for us to borrow. What's your view?
No, I don't think it'll make too much of of a shift. But what we've seen, and this is not just with the requirement for the banks to hold more capital that was brought in 2019. We've seen a structural trend since 2020 where bank balance sheets have been predominantly centred towards vanilla lending, or what's called home lending. So if you look at home lending, it used to be 50% of bank lending. It's now up around 63. Now, when you screw the scrum more and more towards home lending at the expense of real productive lending, well, guess what? You're going to have an impact on productivity growth, which is what we've seen.